What if your financial plan worked this year? Not just at age 65. Traditional advice says wait, then live. But most of your life happens before 65. You've got trips to take, skills to build, and maybe kids to raise. Over the next few minutes, I'm gonna map out a step-by-step framework that funds today's goals and protects tomorrow. We'll use real numbers, some stories, and just keep it simple with plain language. By the end, my goal is that you know what to do first, next, and later. Hi. I'm Andrew Nida from Asset Management Group. If you're new, tap that subscribe button so you don't miss our latest videos on building wealth and, of course, living well. Traditional advice says work 40 years, save for retirement, and finally live. But your 30s, 40s, and 50s, they're not a waiting room. They're full of milestones that need cash, like moving potentially across the country, relocating, grad school, taking a mini sabbatical, or funding child's education. I want you to consider using 4 buckets to help you organize your income now to start planning for your retirement. These 4 buckets, we put a name to them. Let me start with the first one, resilience. Cash for shocks you didn't plan for. We all have them. Second bucket's lifestyle and flexibility. Cash for experiences that you intentionally plan for. Growth and opportunity, money to raise your future income. Lord knows we need that with the cost of inflation. And then long-term security, investment that compound for decades. Gotta love that bucket. Bucket 4, the fun one, it's gonna hold your retirement. But the first 3 make life work right now. When all 4 are funded, you stop rating your retirement for emergencies and you stay on track. Organizing your cash flow is one of the most important things you can do. Let me break down bucket 1, resilience. This is going to be your emergency operating system, your emergency fund, your go-to bucket. This bucket will be your safety net. One unexpected bill should not crash your life. Most experts suggest an emergency fund from 3 to 6 months worth of your living expenses. And you may want to lean toward the higher end if your income is volatile, or you have dependent, or you get paid on commission. Healthy target would be 6 to 12 months of essential expenses. Dual incomes or very secure job, you work for the government, you got something consistent, aim for 4 to 6 months. If you own a business or you have variable income, maybe we go to the higher end, somewhere around that 9 to 12. Let me give you an example. If your essentials, we're talking about like housing, food, insurance, power bill, water bill, your basic transportation, if that runs about $8,000 a month, then your resilience target is $48,000 and $96,000. Put $2,000 back per month, you're gonna have $24,000 in a year. Bump that to $4,000 a month, you're gonna have $48,000. Pretty quick. You want to keep this money in a high yield savings account or a money market. We're not chasing big returns here. We're buying liquidity and peace of mind. And the beauty with higher interest rates, you can get that money working for you, not just the bank, while it's sitting there to protect you. Let me just give you a quick story. And we've all had this happen. One of our close clients, Carla, she had $10,000 in a savings buffer, and her roof sprang a leak and her car transmission failed in the same month, right? When it rains, it pours. The repair cost topped over $7,500. She had it available and she was able to quickly address that need without violating her retirement account. She didn't have to go on a credit card, put it on debt at 15, 20% in today's interest rates. She was prepared for it. You see, this resilience bucket, it's not glamorous, but it's freedom in disguise. All right, let's talk about bucket 2, lifestyle and flexibility. Fund a life you love, right? Don't push everything off to later. Financial planning shouldn't make life smaller. This bucket funds what makes life yours. Travels, hobbies, time off with your children, or maybe even moving closer to where your grandkids are. You want to pick a monthly number for planned fun. You work so hard, 50 weeks out of the year. You got to enjoy it. Create named sub-accounts for maybe a trip like Italy or sabbatical. Create an automated transfer process. Every single time you get paid, you have an automated system that's going to fund these goals. Look, putting $1,500 a month back, 24 months, you're gonna have $36,000 at a 4% ROI. It's gonna be $37,000 to $38,000 available in liquid. Now you can fly that family to Europe or renovate the kitchen without dipping into your investments. And you spend that money guilt-free. And that's the key. Now, planning fun on purpose also keeps impulse spending at check. Make it easy. Stick with long-term, consistent processes that's going to make you successful. Bucket number 3, growth and opportunity. You gotta invest in yourself. Look, your earning power while you're working is one of the biggest assets you have. Use this bucket to boost it. Think of like certifications, a business idea, relocating for a better job, or a career pivot. If A certification is going to cost you $5,000, but it's going to raise your salary by $10,000 a year. You have a 6-month payback. That's great. You should absolutely prepare for that. Look, I give you a quick story here. Lewis, who was a mid-level analyst here, a client of ours in his 40s, decided to do just that. He invested $15,000 in a structured program, saved $50,000 as a runway, and set a 9-month decision date. At month 7, he landed a role paying $30,000 more per year. Planning the runway turned risk into a controlled experiment. He prepared for it, and he's better off because of it. Use this bucket for your own version of Lewis's story. It could be finishing your MBA, buying that rental property, or funding a sabbatical to write a book. Whatever it is, make sure you prepare and create a system that's going to work. Bucket number 4, the fun one, long-term security and compounding while you sleep. Look, I'm gonna be honest with you. This bucket, you're gonna expect long-term results, long-term security. This is your retirement. It's gonna fund 10, 20, 30 years away. Compounding needs time and consistency. It doesn't need perfection. If you invest $2,500 per month and earn an average of 7%, maybe you're investing like the S&P 500, in 10 years, you're gonna have $430,000. In 20 years, you're gonna have $1.2 million. And then check this out, in 30 years, you're gonna have around $2.6 million. Fund a Roth IRA for 20, 30 years. Could you imagine having that much money tax-free? The problem is if you start 5 years late, you will lose hundreds of thousands in potential growth. Small, consistent contributions now are often the most impactful and larger than catch-up contributions later with less time. And then of course, free money, your employer match. If you're working somewhere that offers an employer-sponsored plan and you have a match, absolutely take it. Many employers match a portion of what you save. That's free money. There's no other investment that's going to automatically double your asset and your contribution immediately. Look, you don't get a bonus anywhere else like that. Remember, contribution limits, they've gone up. They adjust yearly. In 2025, employees under 50 can contribute $23,500. And of course, if you're over the age of 50, you get the catch-up contribution. And of course, you want to favor low-cost diversified investments. Lower expenses leave more of your money in the market. Diversified with broad index funds and ETFs if you're in your 401k. High fees and concentrated positions, they eat returns over decades. Be mindful. You want the money to work for you, nobody else. And then of course, let's talk about the big one, debt here. Buy back your cash flow. Look, debt can be a tool or a trap. The goal is intentional debt with growing free cash flow. Use it as leverage or get rid of it. List your debt by interest rate and minimum payment. Decide for yourself what style of payoff plan you want to go with, the avalanche or the snowball. Personally, I like the snowball plan. Small balance first, creates a lot of momentum, many successes along the way. You can consider refinancing or consolidating if it reduces your rate and total costs. Give you a quick example. $500,000 home equity line at 7%, it's gonna cost you about $35,000 in annual interest. Pay an extra $2,500 per month toward the principal. It's going to trim $30,000 off the balance and cut next year's interest rate by $2,100. If your rate's 10 to 12%, you want to prioritize it. A guaranteed double-digit return is hard to beat. Get rid of the debt. It's killing your cash flow, what you work hard for. And of course, protect the plan. A great plan can be undone by one uninsured risk. You don't need every policy. You do need the right ones. Health insurance for catastrophic costs. Disability insurance to replace income if you can't work. So many people forget about that. And then of course, term life insurance. It's cheap, it's inexpensive. And if others are dependent on you to go to work every day to provide a life for them, then cover yourself. Term insurance is an easy way to do it. And of course, the ones we know, homeowners insurance, renters insurance, property and liability. And here's one many people forget about, an umbrella policy. Look, that's an inexpensive way to add a good bit of extra protection. Insurance, it's like the seatbelt of your plan. Most days, it feels completely unnecessary and a waste of money until the day it's not. Do it, have it, protect it. Build the moat around your plan. And then of course, taxes. Plan with after-tax reality. Cash flow lives after taxes. A plan that ignores taxes won't happen in real life. Pre-tax accounts reduce taxable income now, and it comes out taxable later. Your plan would determine if you should fund that type of account. Roth accounts are going to be taxed today, but qualified withdrawals are going to be tax-free. Tax-free wealth is not a bad thing. Mix it up. A lot of times our clients will have a blend between pre-tax and post-tax. But know that their savings and where it's going is dependent on their plan. And then of course, we have our clients really working toward HSAs, self-funding their healthcare bucket. FSAs help with predictable costs, but if you don't use it, you'll lose it. HSA is a much better option if it's available to you. If you freelance or have a side hustle, set aside 25% to 30% of your profits for taxes in a separate account, and then work toward paying quarterly estimates and avoid the penalties, unless high interest savings is paying more than the cost of the penalty. Have your money work for you. Okay, priority stack. What to do first, next, and later. Protect. Look, let's build a starter liquidity reserve. 15,000 to 30,000, roughly 1 to 2 months of your expenses, and then get core insurance, the base policies that are absolutely necessary. Stabilize. Pay all the minimums. Attack the highest interest debt. Grow liquidity towards 6 to 12 months of your essential needs. Then lock in on free money. Capture the full employer match and consider profit sharing or deferred comp elections. Take advantage of it. It's right there. Flex and growth. Fun lifestyle and flexibility to prevent burnout. Invest in skills and opportunities with strong ROI. Keep yourself healthy and keep your family healthy. Long-term security, we need to automate investing. Raise your contributions to your retirement accounts 1 to 2% annually, or step up by a fixed $500 to $1,000 a year. Whatever it takes, make sure you're making the progression necessary. Cost of everything's going up, so should your investments. And then of course, optimize, review, rebalance 1 to 2 times a year. Review your insurance policies, life insurance policies on a consistent basis, 1 to 2 years, to make sure you're not spending more than what you should. Okay, here's the key to make it all work. Mindset and systems. Look, willpower isn't a strategy. If it was, you would be doing it already. Systems is. Here are a few to make progress feel effortless, which is the key. You want to automate your bills, your savings, and investing on payday. You want to put a name to the goal that you have. As an example, Europe 2026, kitchen remodel, retirement 2040. And then of course you want to use some friction. You want to make non-priority spending a bit harder. Require a waiting period for any purchase above a certain limit. Make saving and investing effortless and useless, wasteless spending full of friction. Track just 4 numbers. You want to track your savings rate, your months of expenses saved, and you want to track your total debt and average interest rate. These are great things to make sure you're tracking. Lastly, you want to track your net worth, which is simply the assets that you have minus the liabilities that are on your plate. And here's a common question that many people ask. With considering markets, inflation is now a bad time. Look, there's always a scary headline. The way to stay steady, you gotta have time in the markets, and beats timing the market. You gotta stay consistent. Trying to jump in and out rarely works over decades. Cash has a job. Keep short-term money safe. Investing long-term money, diversify the broad, low-cost funds, and revisit your risk level after life changes. Not headlines. Stay consistent. Build a plan you can stick with. Here's a 30-day action plan. If you want momentum this month, consider this. Week 1, clarity. List essentials, pick bucket targets, open and name your accounts. Week 2, automation. Set up auto transfers for the resilience, flex, growth, and your long-term bucket. Enroll in your employer plan. If you can't max it out, start somewhere, then add 1% every 6 months. Week 3, risk and debt. Verify health, disability, and term life coverage. Use either the avalanche or the snowball method to draw down that debt. Make 1 extra debt payment this month. And then week 4, review and then celebrate. Did the transfers run? Did the balance move? Celebrate the small wins. Then book your 90-day review. It's a lot of fun when you see the success. Look, financial planning isn't a date on the calendar. It's a flexible system that lets you live well now, adapt to change, and still take care of your family's future. Remember these 4 buckets: resilience, lifestyle, and flexibility, growth and opportunity, and long-term security. 3 takeaways: protect the downside first. Protect. Fund your life on purpose, and let time and consistency do the heavy lifting. Start small. Open the accounts, name the goals, automate at least 1 of the transfers. Momentum builds quickly and can compound for decades, literally decades. You don't have to wait for retirement to feel secure and free. Plan for options at 37, 45, 60, and yes, maybe 75. Smart financial planning isn't about later, it's about choices today, tomorrow, and every day after. You work so hard for everything you do, take time to plan for that which you work for. Now go set up those buckets and let's work toward a future where your money supports the life that you want. Thanks for watching. If you found this helpful, hit like and subscribe for more. See you next time, and as always, stay informed, stay empowered, and yes, stay successful.